Hello, my name is Lee Thurburn, and in this video I'm going to talk to you about our experience with financing vehicles instead of purchasing vehicles um, all cash. Now, if I want to say right up front, if you like this video, please do a couple of things. Number one, subscribe to it. Second, please like the video, and finally, put a comment down and I'll answer any questions or comments. I'll respond to your comments if you have any. But these things, as you know, help us get better metrics and get this video seen by more people. Okay, so if you've watched any of my videos before, you know that we've now been in the Turo business a little over 2 years. And the beginning of last year, 2024, we began to experiment with financing vehicles, and we bought a couple of vehicles. We bought one in late February and another one in late April. The one that we bought in April is the one I'm going to start with because it really represents the ideal situation. It's a 2019 Chevy Tahoe. So we bought it at the end of April, which means it was in production, generating revenue for a total of 8 months during 2024. Now, during that time frame, we generated $13,700 in gross earnings. We had variable expenses, which includes the interest portion of the monthly payment, plus maintenance and repairs. Now, we reduced the principal by about $1,000. So, that's just an approximation of what the amount that went towards the reduction in principal was. Might have been a little bit more. But in any event, our expenses were interest, maintenance, and repairs of $3,862, which leaves us with an accounting gross profit of $9,846. Now, we're going to presume that this is the equivalent of positive cash flow, which is actually not 100% accurate because it doesn't account for the reduction in principal, which we made out of the payments. But in any event, it's pretty close. So a contribution margin of 72%. It's a good contribution margin. We had average monthly gross earnings, that's our revenue from Turo, of $1,713, and an average monthly gross profit of a little over $1,200. Now, our actual down payment was zero, but if you plug a $0 down payment, because we financed 100%, if you plug a $0 down payment in, you get an error message. So I put in sort of an average of a typical $1,000 down payment on the purchase of a vehicle like this, which would have given us a 985% cash flow return, gross profit return on our down payment, and means that we're making more money per month than we actually would have put in a down payment. Now, the reality, of course, is we put $0 down, so it's even better than that. This represents, I think, the most perfect ideal scenario for a financed vehicle providing a return on investment for you being in the Turo business. Now, the next worksheet that we have shows all of the vehicles, all 7 vehicles, and our totals for the year 2024. The first vehicle is actually a 2019 Dodge Caravan, and we bought that vehicle at the end of February, so it was in production for 10 months. However, after about 6 months, now that car had 62,000 miles on it, and you probably know the story if you've watched any of my other videos, but that car had 62,000 miles on it. We were super excited because it was low miles, and we thought this is going to be a great vehicle and last a long time. Well, after about 6 months in production, in the middle of the summer, we had it on rent, and the guest called us and said it won't move. Well, they were, about 2 hours away from Dallas, so we had to go up and to get the vehicle, had to have it towed back, we took another vehicle to them, had to get that vehicle towed back to DFW, where we put it in the shop, and it turned out to be a blown transmission, and it, at that time, had about 75,000 miles on it. Unfortunately, even though I did a lot of research, I never discovered that this is actually a fairly common problem with Dodge Caravans at the 70, 80, 90,000 mile range. Transmissions go out on these things. It's a relatively common issue, which if I had known that, I wouldn't have bought the vehicle, but I didn't know that. It cost us $6,500 for towing and transmission repair to get that fixed. So that's added into the variable expense for that vehicle, which shows a big loss for the year. Now, again, when we bought that vehicle, we didn't put any money down, so we just show $1,000 for the same reason as on the Tahoe as our down payment on both of those vehicles. Now, the next month, no, I said the next month, in May, let's see, April, May, yeah. In May of 2024, we bought two cars, a 2016 Suburban and a 2017 Suburban. In June, we bought a 2019 Suburban. And then in August, we bought both a Suburban, a 2014 Suburban, and a 2018 Tahoe. Now, for these big vehicles, the peak season is the summer season. They're in very high demand. They rent really great. They rent almost nonstop because people like them for vacations, and they're ideal vehicles for family vacations. The Tahoe, the Suburban, the 16 Suburban, and the 17 Suburban, and the 19 Suburban all received revenues during the majority of the summer travel season, which is why their revenues are good. The 14 Suburban and the 18 Tahoe were put into production right at the end of August. They really only had 5 months, the last part of the year, where they were generating revenue. And so they didn't make as much, and it reflects in the contribution margin percentages and so forth. Now, if you look at all 7 vehicles for the portion of the year, the total of 48 vehicle revenue months, you can see that we had gross earnings of $55,480, variable expenses of $35,947, gross profit of $19,533, which was an average of a 35% contribution margin. And then you can see that our gross profit basically cash flow per month, was about $407 per month. Now, presuming that you calculate a deposit of $1,000 on a down payment of $1,000 on each of the 19 Caravan and the 19 Tahoe, that's a total of $14,000 in down payment, which means we had 139%, say 140% return on investment for the compared to the down payment in terms of cash flow for the year. But I've got another revision that I want to share with you, and that is I make the presumption that because, and what I'm looking at here is the variable expense. You'll see the variable expense for the Dodge Caravan compared to the $13,200 of actual variable expense. I pull out the $6,500 of repairs and towing for the transmission repair. I show that as a down payment. I'm treating it as if I put that down on the car, and that increases our down payment amount to $19,000 instead of $14,000 for the for the total of the vehicles, and that changes our calculation because we actually had enough revenues to cover the other variable expenses. There were some other repairs related to that car. You can see that it was the most expensive car, even not including the the transmission repair. We still had quite a few other things that went wrong with that vehicle. It's certainly not the same quality level that the Tahoe and Suburbans are. But in any event, if we make that adjustment, we had about a 300% return on our down payment if you kind of just treat it that way. Now, sorry, that's the wrong column. About 150% return on investment on our down payment. Now, we had 48 months of vehicle revenue during 2024. When we look at 2025 and we take 7 vehicles times 12 months, that's 84 vehicle months. We're expecting, because we're going to get them in place, all of them are going to be generating revenue during the peak summer months and a couple of other times like spring break season and Christmas season and that sort of thing. We expect to have about 120% average monthly revenue increase. So we're expecting about $120,000 in $122,000 close to in gross earnings, about $62,000 in variable expenses, about $60,000 in gross profit, with a $19,000 recalculated down payment, that should be about a 300% return on investment that we'll see during the year. Now, all of this presumes, of course, that we don't have any major maintenance issues, any big engine repairs, any big transmission repairs, that it's just normal maintenance, brakes and that kind of stuff, tires, brakes, and so forth. Of course, normal maintenance items, are going to occur. If we're surprised by any major engine or transmission repairs on these vehicles, then we're certainly not going to see the kind of return on investment. However, the positive cash flow being generated in the $60,000 range will be sufficient, I think, to be able to cover any significant repair issues that do come up on one of the vehicles. It's a roll of the dice. You never know what vehicles are going to need, and that's just impossible to predict. But what is important to have is enough positive cash flow to be able to cover the expenditures that do come up in the rental car business. I hope this helps you understand what a reality situation might look like for you. This is how I did an analysis and used basically a spreadsheet to predict what the next year should look like. And this is based upon my experience in the first year of our venture into financing vehicles. We do plan to buy more vehicles financed this year and add to our fleet. The vehicles will be newer, they'll be higher quality, and hopefully will not only provide us with a better return on investment, but will improve the quality of our fleet in terms of how we're ranked by our guests. We did have a problem with Turo's new mechanism or algorithm for calculating all-star hosts. We fell out of the all-star host classification in the middle of January. And honestly, since that point in time, we've seen a decline in rental demand. I do not know how much of that is attributable to no longer being an all-star host. We hope to regain all-star host status in the next point, which I think is April. We have 4 other vehicles other than the ones you see. They're older, lower quality, lower demand. Well, the demand is decent on the cars. They don't rent for as much per day as these bigger vehicles do. But they do have a lot more maintenance issues. They're Volkswagen Jettas, and they have really hurt our all-star rating because of maintenance issues. And so we're in the process of kind of flushing those out of our fleet and elevating our fleet to higher quality, bigger vehicles, which generate more money and have a lower maintenance problem, incident kind of situation. So hopefully we'll see that kind of flush through here in the first quarter of this year, and we'll return to all-star host status. I hope this helped, and I look forward again to any questions that you may have. Please hit the like button, send us a comment, ask a question, and subscribe to this channel. We would appreciate it very much. Thank you for watching.